Earlier this year, the federal government announced that the capital gains tax is increasing from 50% to over 66%, causing a lot of outrage, and also some confusion. Although paying more taxes always sucks, the good news is that we're not actually going to be paying 66% in taxes. To better understand this increase and whether you'll be personally affected by it, it's important to first understand how capital gains tax actually works in Canada. Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about the capital gains tax. We'll go over what a capital gain is, how the capital gains tax is calculated, including the new rate increase from June 25, 2024. A detailed example to clarify the situation and see how the rate increase actually impacts your tax bill. At the end of the video, I'm going to share 4 tips that you can apply to minimize your capital gains tax. So let's jump right in. First of all, what is a capital gain? It's basically the profit you make when you sell what we call capital property, such as real estate, stocks, or equipment used in your business. For example, if you invested $1,000 in stocks, and you sell them when they are worth $1,200, you'll have a capital gain of $200. Or, if you sell your cottage for $400,000, but you bought it for only $100,000, you would have a capital gain of $300,000. By the way, you would also incur a capital gain if you decided to start renting your house, because the CRA considers that a change of usage is the same thing as if you had sold the property. If you're planning on renting out your home or cottage, be sure to check out my video linked in the description box below, to avoid any nasty tax surprises. Next, how is the capital gains tax calculated? Before June 25, 2024, 50% of the capital gain was taxable. In other words, if you had a $300,000 capital gain from the sale of your cottage, you would include 50% of that amount, so $150,000, in your net income when filing your tax return. The $150,000 would then be taxed at your marginal tax rate. But for transactions which take place after June 25, the inclusion rate is now 66.7% instead of 50%. That said, individuals like you and me get a $250,000 threshold before the new rate applies. In other words, 50% of the gain up to $250,000 is taxable, and any amount which exceeds this threshold has to be included at 66.7% instead of 50%. So, using the $300,000 capital gain from earlier, you would include 50% of $250,000, plus 66.7% of the remaining $50,000, for a total of over $158,000 in taxable capital gains. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Alright. Now, let's take our example one step further, by looking at the actual income taxes on the $300,000 capital gain. For simplicity, we're going to assume that the full amount is taxed at the highest federal tax rate of 33%. If the cottage was sold before June 25, 2024, the taxes would simply be 33% of $150,000 or $49,500. After June 25, the taxes amount to $52,256. As you can see, the increase from 50 to 66.7% results in an additional $2,756 in taxes. On a $300,000 profit, that's less than 1%, so the rate increase really isn't that bad. However, that's still over $2,700 that we would have preferred to keep in our own pockets. So let's look at 4 things that you can do to minimize your capital gains tax and keep more money in your pockets. First, when possible, buy the property with at least one other person so that ownership is split. Since the $250,000 threshold is per individual, this will allow a larger portion of the capital gain to be included at only 50%. For example, if you own a rental property 50-50 with someone else, and eventually incur a $400,000 capital gain when you sell it, the $400,000 will be split between the two of you, so $200,000 each. Since that's below the $250,000 threshold, the full amount will be included at 50%, $100,000 each for you and your partner, for a grand total of $200,000 in taxable capital gains. A loan buyer would instead have $250,000 at 50%, plus the remaining $150,000 at 66.7%, which would result in over $225,000 in taxable capital gains. That's a $25,000 difference compared with split ownership. Second, prioritize investing in stocks and bonds via registered accounts, such as a TFSA or RRSP. Capital gains are not taxed when they are generated in these types of accounts. If you want more information on how these registered accounts work, I'll link my videos about TFSAs and RRSPs in the description box below. Third, realize any unrealized capital losses to offset your capital gain. For example, if you invested $10,000 in stocks but they are only worth $7,000 today, and you don't expect their value will go back up, you can sell them to realize the $3,000 loss. This capital loss multiplied by the inclusion rate will give you an allowable capital loss, which can be applied against your taxable capital gains. Keep in mind this will only work if the stocks are held in unregistered accounts. If they are in registered accounts like a TFSA or RRSP, you won't be able to deduct the losses. My final tip is to optimize your principal residence exemption. This applies if you own a cottage in addition to your main house, because both can qualify for the principal residence exemption, but only one can be designated as principal residence for any given year. There is a way to minimize your capital gains tax when you sell these properties, and it's not by simply designating the one with the highest capital gain as your principal residence. I'll explain how to do so in a future video, so keep an eye out for that. So there you have it. We discussed what a capital gain is, how the capital gains tax is calculated, including the new rate increase from June 25, 2024. And we used a detailed example to clarify the situation and to see how the rate increase actually impacts your tax bill. I also shared 4 tips to help you minimize the capital gains tax on any capital property you sell. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.